Hello everyone, this is Professor Zhao at MTSU. In this chapter, I will give you a brief overview of mutual fund industry. Mutual fund is a big thing on the financial market, and for portfolio manager, mutual fund is a gigantic industry, covers tens trillions US dollars. Right? And you can look at the total size of the mutual fund industry. You'll be surprised how big that industry is. As of year 2010, the total size of the assets under mutual funds management is about 12 trillion US dollars. It's about 12 trillion US dollars. And today on the market, there are about a little over 10,000 different mutual funds available for investors. Right, so this is a really big thing on the financial market. It's a number one sector in the money managing industry. Now let's take a look at who is managing the mutual fund. I mean, you may find more than 10,000 mutual funds available on the market, but those mutual funds are managed by several different investment companies. And investment companies are special financial institutions. They are different from commercial banks or investment banks. And what investment company does is they help their clients to manage money, right? And who are their clients? Mostly those are institutional clients, such as pension plans, retirement plans from large U.S. corporations or from government agencies. And also they manage money for banks, for insurance companies, as well as other institutional investors. So investment companies actually manage large amount of wealth on the global market. And the reason why investors need investment company is because investment company help their clients to keep records and manage their accounts. It offers diversification and divisibility, and more importantly, it offers professional management and lower the transaction cost. There are two different types of investment company. The first one is called a unit investment trust. And in a unit investment trust, the money pulled from many investors, and money will be invested in a fixed time period. And also the portfolio structure will be fixed for the life of the fund. That is a unit investment trust. And so-called unit investment trust was pretty popular before 1950s, but later on it lost its popularity, and now we have more managed investment companies. And those investment companies offer two major types of funds. One is open-end funds, and the other one is closed-end funds. And open-end funds are much more popular than closed-end funds. And the difference here is for closed-end funds, if you're an investor of closed-end funds, you're pretty much like holding a stock on the market. And if you want to withdraw money from investment, you simply sell your shares to other investors, and the share will be traded at a value equivalent to net asset value of each share of the mutual fund. Right? So that is nature for closed-end fund. And a closed-end means the investment company cannot increase the size of the mutual fund. The size of mutual fund is fixed, right? And they do not redeem shares. They do not issue more shares. And the investor want to sell shares or buy shares, they have to sell or buy or sell from another investors. That is a closed-end fund. And a closed-end fund is not a popular way for mutual funds to promote their businesses. And nowadays, the most popular form of mutual fund is open-end fund. Open-end fund allow investors to get in and get out anytime that they want. Right? And if investor want to buy and open-end fund, they simply buy the fund, the mutual fund company directly. And if they wanted to sell it, you cannot sell your open-end fund to another investor. You have to redeem it directly from the mutual fund. And of course, the price would be redeemed at net asset value of each share. So that is a difference between open-end fund and closed-end fund. And both open closed-end fund charge so-called a load. And what is a load? Load is the sales commission charged against clients when they purchase either open-end fund or closed-end fund. And the load is used to compensate the marketing costs of mutual funds. And typically a load would be about 5% of total value of the investment. And let's say if you want to invest in $100 worth of mutual fund, then the total price that you need to pay with a 5% load would be $105. So that is a mutual fund load. And people hate to pay upfront load. Let's say 5% upfront charge, and people hate that. So nowadays, a lot of mutual funds offer so-called a no-load fund, which seems very attractive. But most of the no-load funds simply do not charge you load at the front, but they will charge you load when you redeem your shares. It's the exit load, not front load, but the exit load. And sometimes exit load may impose higher cost for clients. So here is the major difference between closed-end and open-end funds. And for open-end funds, there's no limitation on how many shares that the mutual fund can issue. And clients can go in and go out freely when they purchase or redeem shares from the mutual fund company directly. But for closed-end fund, the total size is fixed at the very beginning, and the mutual fund company cannot issue extra shares. So in order to buy and sell closed-end funds, investors have to go to the market to buy it or sell it with other investors. In terms of pricing, when you either purchase or sell a closed-end fund, the price equal to its net asset value plus any applicable load. But for open-end fund, since you are trading on the market, the trading price may deviate from net asset value. And this figure showed you that for most closed-end fund traded on the United States, you may find significant discount in terms of price. For example, for Eaton Vance Tax DIV Inc., this closed-end fund, the net asset value is $18.75. But if you buy it on the market, the price is only $17.19. Where you may enjoy that 8.3% of discount. And that's good news. It may be good news, maybe not, because that discount may persist. In the future, when you want to sell their share, of course, you will have similar amount of discount. So there may not be any benefits for investor to trade open-end fund when you see there's a significant amount of discount. And for open-end fund, such discount cannot be found because you are directly dealing with the mutual fund, and the price that you need to pay should be equal to the net asset value, which is calculated by a mutual fund company at the end of every business day. Let's say today you wanted to buy a mutual fund issued by Merrill Lynch, and the net asset value in the morning is $5.30. And but the price that you need to pay is now $5.30 because during the trading day, the value of the stock in that portfolio may change. And the mutual fund will allow you to buy that share at the closing net asset value. So that is how you buy a share from mutual fund company if it's open-ended fund. As I said, there's more than 10,000 mutual funds available on the markets, and those mutual funds offer very different products to their clients. And you may find commingled fund, real estate investment trust, which is focused on real estate assets investments, and some mutual funds offer you money market alternative, which means the money that you invest with them will be fully invested in the money market instruments. And equity funds will focus on stock investments, and specialized sector funds will focus in a certain sector on the stock market. Let's say information technology sector specialized fund. This fund will simply focus on the stocks in the information technology sector in the United States. Of course, the bond funds focused on fixed income securities. And many mutual funds also invest internationally. They offer so-called international funds or global funds. And mutual funds can also be distinguished based on its investment policies. And typically you see a balanced fund, growth fund, or value fund. And the balanced fund tend to combine both growth company and value company together. And there might be a very nice mixture between bonds and the stocks. So the balance here means the balanced risk-return trade-offs. And investment policy can be very different among different mutual fund companies depending on their asset allocation decisions. And most funds are actively managed funds, which means mutual fund managers need to do research, pick individual securities, and their goal is to beat the market indexes. And also we have a lot of index funds. Index funds are passively managed funds. And in those funds, money managers believe that they are not smarter than the market. And they believe in the story of market efficiency, and what they do is simply mimic the market index so that their return should be equivalent to the market index return. That is called an indexed fund. So typically speaking, it involves much less work in the index fund. That's why a lot of index funds charge much lower management fee for their clients. This table shows you the big picture for this mutual fund industry in the United States. As you see, as of this is a pretty old statistics, and the year was year 2004. In year 2004, the total size of the assets managed by all mutual funds about 12 trillion US dollars. And among 12 trillion US dollars, 6.5 trillion US dollars are under management of equity funds. As you see, nearly 3 trillion US dollars are in capital appreciation focused funds. 1.66 trillion US dollars are in international equity funds, and nearly 2 trillion US dollars are in so-called total return funds. And the total return funds combines both growth companies and the value companies. And for value companies, their major return is dividends, and for growth companies, the major part of income would be the capital gains. So total return means a balanced dividend and capital gain stocks. There are about 1.68 trillion US dollars are under management of bond funds, and bond funds invest in different places such as corporate bonds, high-yield bonds, international bonds, government bonds, so on and so forth. And the total size is about 1.6 trillion US dollars. Hybrid fund, which combines both bonds and stocks, manage about 0.7 trillion US dollars. And surprisingly, you see a little over 3 trillion US dollars are invested in money market funds, right? Where you see high liquidity, safety of the investments, but low return of the investment. Account for 3 trillion US dollars. So this picture showed you the structure of mutual funds in terms of where they invest their money. Now, let's take a look at how money manager in a mutual fund make their money. So how do you make money? Right? You help your clients to invest, then how you charge against your clients. Right? And for mutual fund, they charge 2 different types of fees. The first one is so-called load. Right? And load is used to compensate marketing effort by selling mutual funds to clients. And typically, brokers who sells mutual funds to investors will get that load. And still the money goes to people who does the marketing, especially the brokers help investment company to sell their shares. But what about the mutual fund managers? How they make their money? Well, they make money through charging so-called operating expense. And operating expense typically a fixed percentage of total value of the fund. Let's say 1%, 1.5%, or 2%, which means every year, money managers are going to charge 1 to 2% of the total value that they manage as the management fee or operating expense. Of course, management fee is used to offset the operating expenses. And for the marketing, the mutual fund charge a load against the clients to compensate for its marketing expenses. Load can be front-end load or back-end load. It's common to see back-end loads nowadays because most customers do not like front-end load. In addition to load, mutual fund companies also charge so-called 12B1 charge. So 12B1 charge is the annual charge against clients to compensate for marketing and distribution costs. So the load is one-time charge. For clients, but every year clients also needed to pay additional fee to compensate for marketing and distribution effort made by the mutual fund company. That is 12B1 charges. So some mutual funds have high expense ratio than the others, and typically actively managed funds tend to have higher expense ratio because they need to hire a lot security analysts and security traders. They spend more money on the research. That's why they charge higher fees, typically more than 1.5%. And some mutual funds actually adopt passive investment strategy where they simply mimic the market index. In that case, it involves much lower operating expense. Therefore, they charge lower expense ratio or lower management fees. So from investors' perspective, of course, they need to focus on NAV when they purchase or sell a mutual fund unit. But in addition to NAV, net asset value, they also need to consider front-end load or exit load or 12B1 fee as well as the management fee. So here the example show you 3 different mutual funds. First one charge nearly 6% front-end load, but 0 back-end load with 0.25% 12B1 fee on the annual basis and a 1% expense ratio. And the Class B offers investor no front-end load but 4% back-end load with higher 12B1 fee, 1% 12B1 fee each every year, as well as higher expense ratio, 1.7% 4%. So Class B looks very friendly at the front, but Class B charges a lot of money against their clients in terms of management fee and a 12B1 fee. And for Class C, 12B1 fee is also set at as 1%, and this is a truly basically a truly no load fee. It has no front end load and basically zero back end load, and with expense ratio of 1.05%. Right? So if you're an investor, which fund will you choose? Let's say all three funds will deliver exact the same investment return. I mean, given the same investment return, what you can get is the total return after all those fees, right? And a lot of people say Class C looks nice, no load. 1% 12B1 fee reasonable, 1% expense ratio pretty reasonable, right? But let's look at some numbers. So this table showed you the total amount of investment investor can get after 20 years of investment, 20 years of their investment in three different funds, right? With same performance, exactly same performance, exactly same investment, but different fee structure, right? A has front load fee, B has exit load, and C is typical no load fund. Is a no load fund, right? And here you see that, okay, for the same amount of investment, surprisingly, A can give clients largest amount of return after 20 years, $88,000 versus $73,000 from Fund B. And Fund C looks very attractive, but after 20 years, it's just $74,000. So what's the trick? The trick here is investor need to look at the 12B1 fee. 12B1 fee is pretty significant for both B and C. It's much higher, 1%, but Fund A only charge 0.25% 12B1 fee. Right? And when investing in mutual fund, of course, they need to take a look at the fee structure, but their final return, the final return of the investment also have something to do with the tax. And many investors might think that, okay, any gain made by the mutual fund must be taxable, but actually that is not the truth. And most mutual funds subject to zero tax. And here's the little tax rules on the mutual fund business. Most mutual funds do not pay tax, even when they are making money for their clients. Right? And the condition here is all the incomes, most incomes need to be distributed back to shareholders, and also the portfolio need to be well diversified. If that is the case, there is no tax against the mutual funds. But when investors receive incomes from the mutual funds, they need to pay taxes on either dividends or capital gains that they get from the mutual funds. Some mutual funds trade a lot. In that case, turnover ratio is high. When turnover ratio is high, what's the implication? Well, when turnover ratio is high, investors may pay tax. And also when turnover ratio is high, investors, of course, pay more transaction costs. And typically speaking, a passively managed fund has a low turnover ratio than an actively managed portfolio. Right, so that is a very basic aspect of mutual funds in terms of fee structure, how they operate, the difference between open and closed-end funds. So let me ask you one question. If you are a mutual fund manager, what can you do to make more money for the mutual fund company? What can you do? Some people say, hey, let's be smart. Right? Let's find a magic investment strategy so we can maximize the gain for our clients. Is that the best way? Actually, it is not. Why is that? Because as a manager, the way that you charge your clients for a service is not performance based. It's not performance based. It's a size based. You see, there's no performance rewards in a mutual fund. Let's say you make 20% for your clients, right? Can you take a cut in that 20% again? The answer is no. Mutual fund manager only charge management fee every year, regardless of the performance. Even mutual fund doesn't perform well, lost money for their clients, guess what? Mutual fund managers still charge that 1 to 2% management fee against their clients. So it's not performance-based compensation, right? It's size-based compensation. So the best way for mutual fund manager to make more money is not to perform better, but make mutual fund bigger and bigger. So nowadays, if you have a chance to visit any mutual fund companies, you will see that any mutual fund company tend to have a large sales department. There might be 10, 20 financial analysts working for a typical investment company, but you might be able to find hundreds associates working for the mutual fund company, simply selling mutual funds. So the performance of mutual fund company is not performance based, but marketing effort based. So the best way that you can maximize your gain is simply do more marketing, make your mutual fund bigger so that you can receive more management fees every year. And in the longer term, marketing effort has something to do with the performance, right? Because no matter how much money that you invest in your marketing, you have to show your clients that your fund is a better fund than the others. How can you prove that? Well, you have to prove that through your performance. Although you do not get any performance compensation, but in order to make your business bigger, you have to show your clients you are performing better than your competitors. So in this sense, performance also matter in the long term for mutual fund managers, right? So while they are doing a lot of marketing work in order to sell more mutual fund shares, the other thing that they can do is to improve their performance over a longer term, so they can attract more customers to increase the total value of the mutual fund, so they can charge more management fees. Okay, now let's take a look at a new type of mutual fund, and this new type of mutual fund is called exchange traded funds, simply put, ETFs. Right? So what is ETF? Well, ETF is essentially a mutual fund. But the difference between ETF and a mutual fund is that, first of all, ETF can be traded like a stock on the market. I mean, for mutual fund, you have to buy or redeem shares directly through the mutual fund company, but the ETF can be traded on the stock market like a stock. So it offers convenience of transaction for clients. Right? And the second difference is that this ETF charges much lower management fees. Right? Previously, we learned that the management fee ranges from 1 to 2%. Right? That is significant cost for any investors. An investor do not like that. And also, we know that many mutual funds are in that. They invest in stock market indexes. They don't need to they don't need to spend a lot of money to do security research, make investment decisions. They simply mimic the market. I mean, it involves least amount of operation expense. They should charge much lower fees, right? But 20, 30 years ago, even those index funds charge 1% or even higher than 1% management fees against their clients. So the smart investment professionals found a new way to attract their clients by lowering the management fees. How? How to lower management fees? Well, the best way to lower management operation cost is stay away from the active portfolio management. You go for passive management. In that case, you can minimize the cost and expenses. And the ETF is based on this idea. And the ETF charges much lower management fees against clients, typically 0.25%. It can be lower. Some of them charge something around 0.3%, 0.5%. But anyway, it's much, much lower than traditional management fee charged by mutual funds. That is a new type of mutual funds. It's tradable, and most of those ETFs are passively managed fund. So it allows them to lower the operation expense. And here's the example of ETFs. And ETFs are issued by large investment companies such as Barclays Global Investors, Merrill Lynch, State Street, Vanguard, so on and so forth. Those are investment companies. Those investment companies manage mutual funds, and they also sell ETFs to accommodate the rising demand from investors, because investors like ETFs because of the low management fees. And here, most ETF products are passively managed, and they track certain market indexes. For example, SPY. SPY is also called a SPDR. This is one of the first ETFs offered by investment companies, and this ETF tracks S&P 500. Right? And DRA is another ETF product, tracks the performance of Dow Jones Industrials. So how do they track the market index? Well, there are many ways they can utilize, but the basic way is they invest in all the stocks contained in that index, so that the performance of the fund should be identical to the market index performance. Right. And the ETF can mimic certain broad market index. It can also mimic sector index or industry indexes. And some ETF actually can invest in foreign markets, right? Foreign markets. Make sure the performance of those funds are identical to a foreign stock market performance. So here's just an example of ETF products and ETF issuers or sponsors. Now let's take a look at what ETFs are invested in. And here is the picture showed you, okay, first one that you see, okay, rising trend, right? This rising trend shows you that the size of ETF increased tremendously. Back to 1998, there's only a small amount of money invested in ETFs. Right? That is the early stage of ETF, late 1990s. But ETF has developed very tremendously during the most recent 10-20 years. In year 2010, the total size of ETF is almost reaching $1 trillion US. Among the $1 trillion US, most money are invested in US stock markets, and with significant investments in bonds, commodities, as well as international stock markets. And this picture shows you the market share of mutual funds and exchange traded fund, along with closed-end fund and unit investment trust. And right now, unit investment trust is disappearing. Only account for a very small percentage of this money managing industry. And the mutual funds, of course, that is dominating force on the market back to year 2010, right? And it manages a little less than $12 trillion US of assets. And exchange traded fund increased very dramatically from basically zero back to 1998 to nearly $1 trillion in year 2010. And the closed-end fund actually is shrinking. The market share of closed-end fund is shrinking. Right now it only occupies a very small percentage of the money managing industry. So this pie showed you the number in year 2010. In year 2017, 7 years later, what is total size of the ETF, exchange traded fund? Well, the answer may surprise you a lot. In year 2017, the total assets under management of ETF is almost $3 trillion. $3 trillion. So during the last 7 years, the total size of exchange traded fund has been tripled. Where do they get their business? Well, most businesses are from mutual funds, and more clients are moving away from mutual funds, and they are investing in ETFs. Right? So nowadays, you will see that exchange traded funds are occupying a larger percentage of the market for this money managing industry. And what I can say here is they are getting something around 25% to 35% of the total market. And in the future, for the future 10 or 20 years, you might see the same pattern, and they might continue to increase in the future. And I would say maybe in year 2020, the total size of ETF would be $5-6 trillion. That could be the case. Now let's take a look at mutual fund investment performance. From investors' perspective, you would expect the smart mutual fund managers can deliver a pretty good performance for their clients. They charge money for the investment services they provide for their clients, right? 1 to 2% management fee. And they're supposed to do well, but when you look at the number during the last 50 years or so, you will be disappointed. On average, mutual fund performance cannot beat the market index, period. Cannot beat the market index. Right? And that performance is before all the fees, right? Before the load, before the management fee. And after management fees, load, it's even worse. Right? So many people would say, hey, why would we invest in mutual funds if they cannot be the market? Right? The recent surge in ETF explains. People invest in something that cannot be the market. Then why would they do that again? So more and more investors recognize this, and they are moving from actively manage mutual funds to ETF. So for ETFs, they simply track the market, and management fee is much lower. And for those highly liquid ETFs, management fee can be lower than 0.25%. Right? And that is a natural consequence of poor performance of mutual fund industry during the last 15 years or so. But among all the mutual funds, I say on average, mutual fund cannot be the market. But among those more than 10,000 mutual funds, some of them really do better job than the others. Right? Really do good job than the others. And the research showed that the mutual fund performance tend to persist. If you find one mutual fund perform better than the others, can you say they do better job because of the luck? And the research says it's not. And good mutual funds tend to perform better than the others in a sustainable way. So this is a table showed you the consistency of investment results. And poorly performed mutual funds tend to continue on their poor performance. And better than average mutual fund tend to perform better than the average in the future years. And there are many places that you can get useful information on mutual funds, such as Morningstar, Fund Prospectus, Yahoo Finance, Wall Street Journal, Investment Company Institute, American Institute of Individual Investors, and of course you can get mutual fund information from your stock brokers. So that is a mutual fund, very simple and easy chapter. Now let's take a little time going through the homework. Right, we just did the chapter 22. That's investment process. Now let's look at chapter 4, mutual fund. Mutual fund. Number 19. Which one of the following invests in a portfolio that is fixed for the life of the fund? Fixed for the life of the fund. The answer is D. Right? And fixed means the structure of portfolio is fixed. They never change. Stocks, they never, once they invest in stock, they simply let stay there, and they won't do any rebalance. And also the size of the fund is fixed. That's a unit investment trust. That is the oldest form of mutual fund. Number 20. What is a private investment pool open only to wealthy or institutional investor that is exempt from SEC regulation and can pursue more speculative policy than mutual funds? The answer is hedge fund. Hedge fund is not regulated, right? But only open to wealthy individuals. Number 21. Advantages of investment companies to investors include all but which one of the following? Right? We learned that investment company do a lot of good things for their clients. They offer professional management, low cost, diversification, record keeping, so on and so forth. But the one thing they can never do is to guarantee the rate of return. And actually, based on regulation, it is against the law for mutual fund to provide guarantee on rate of return. So D is the best answer. Number 22. A contingent deferred sales charge is commonly called contingent deferred. Deferred means they don't charge you right now, but when you decide to leave the mutual fund, they're going to charge you the exit fee. That is back end load. B. Number 23. As of year 2011, what percentage of mutual funds assets were investing in equity funds? And that percentage is about 50%. More precisely, 54% if you take a look at the table in the textbook. Number 24. In year 2011, what percentage of mutual funds assets were investing in bonds? And most close number is 14%. 14%. Number 25. Management fee for open-end and closed-end funds typically range between what percentage and what percentage? What percentage? Right, so here you see as high as 5%, 8%, those are all wrong, and typically 1 to 2%. And some mutual fund may charge a lower fee if they do passive strategy, but I think A is the best choice, 0.2% to 1.5%. 1.5%. Number 26, the primary measurement unit used for assessing the value of one stake in an investment company is NAV, net asset value. Number 27, net asset value is defined as what? Right? So, of course, it's market value of assets minus any liabilities and divided by shares of outstanding. D. Number 28, assume that you have recently purchased 100 shares in an investment company. Upon examining the balance sheet, you notice that the firm is reporting 225 million assets, 30 million liabilities, 10 million shares outstanding. What is NAV? So you simply apply the equation. Apply the equation in question 27. Right? Market value, total value 225 minus 30 liability divided by 10. That will give you $19.5 of NAV per unit of that mutual fund. Number 29. The Vanguard 500 Index Fund tracks the performance of S&P 500. To do so, the fund buys shares in each S&P 500 companies. Right? They buy all 500 companies, but what's the weight? The weight should be in proportion to the market value weight of the company as equity in S&P 500. So the structure would be exactly the same as S&P 500 index in order to track its performance. Number 30. Investors who want to liquidate their holdings in a closed-end fund, right? Can they redeem their shares from the mutual fund company or something else? And here, remember that for closed-end company, for closed-end mutual fund, the only way the investor can get away from the mutual fund is to sell it on the open market to other investors. They cannot redeem it. They can only sell it to other investors. When you say redemption, you are redeeming your shares from the mutual fund companies. That's the difference between closed-end fund and open-end fund. Number 31. What fund is defined as one in which fund charges sales commission to either buy into or exit from the fund? That is a load fund. Number 33. An open-end fund has an NAV of $16.50 per share. The fund charges 6% load. What is the offering price? So when investors need to buy this share, of course, they pay NAV 16.50 per share plus 6% of load. So the answer equal to 16.5 times 1 plus 6%, which will give you $17.55. Number 33. The offer price of an open-end fund is $18, and fund is sold with front-end load of 5%. What is NAV? So it's this is a opposite calculation opposed to number 32. So answer equal to $18 divided by 1 plus 5%. That will give you $17.10. What a fund stands ready to redeem or issue shares at their net asset value? This is the open-end fund. 35. Higher portfolio turnover resulting what? First one, resulting greater tax liabilities. That could be the case. 2. Resulting greater trading cost in which investors have to pay for. That's true. 3. It is a characteristic of index funds. So I think the third statement is wrong because high turnover ratio is typical for actively managed fund, and index funds are passively managed. They're supposed to have low turnover ratio. So only 1 and 2 are correct. Number 36. Mutual funds that hold both equities, fixed income securities in relatively stable proportion are called balanced fund. Number 37. Specialized sector funds concentrate their investments in a particular industry or sector, right? That's D. Pretty straightforward. Number 38. Under the SEC rule, the manager of certain funds are allowed to deduct charges for advertising, brokerage commissions, so on and so forth. I mean, those are marketing and sales related expense, right? And these fees are known as 12B1 charge. By the way, 12B1 is the number of the provision under SEC rules. Number 39. What is an example of ETF? ETF, Vanguard, that is investment company, right? Samura, what is that? I don't know. Open-end fund, and mutual fund, and a Spider. Okay, this Spider is one of the first exchange-traded funds. So answer is A. Number 40. If you place an order to buy sell a share of a mutual fund during the trading day, the order will be executed at what price? Okay, the order will be executed at net present value, right? At the market close on that trading day. Number 41. Which of the following ETF tracks S&P 500 index? The answer is very simple. Spider. SPDY. Number 42. Advantages of ETF over mutual funds include all but one of the following. ETF can be traded on the exchange. ETF offers low management fees, so on and so forth, right? So here, A is good. It can be traded continuously. B, ETF can be sold short or purchased on margin, right? That's also true because ETF has similar nature of stock. It can be short or sold. It can be purchased on margin. C, ETF providers do not have to sell holdings to fund redemption, and that's true because investor can simply buy an ETF freely on the market. So A, B, C are all advantages. And D, ETF value can deviate from NAV because of continuous trading. ETF value always equal to net asset value. So D is the best answer. Number 43. Which of the following funds are usually most tax efficient? Equity fund, bond fund, ETF, special sector funds. To be tax efficient, the fund need to have low turnover ratios. Right? Low turnover ratios. So index fund could be the candidate. ETF, mostly passively managed, should have low turnover. Therefore, those funds tend to have low tax burden. So here you only see ETF. So ETF is the best answer because it's mostly passively managed with a low turnover ratio. Therefore, it's the most tax efficient. Right, so that's Chapter 4, Mutual Fund.